We are live with Quincy Krosby this morning, and we could not be more delighted. And I just said, well, I'm gonna have to share a quick little memory lane, and I can place the timing and I can place the event. So first I want to welcome our clients and those who are checking Blue Heron out. And we want to also thank Northrop Grumman Federal Credit Union and for putting the word out about today's session. So here's my quick little memory lane. I was very, very pregnant with Lizzie, who is now just finished her freshman year of college. So that just tells you the span of how long we have known Dr. Quincy Krosby. I'm going to read from her just amazing, impressive bio here, because it speaks so much to what's taking place and drawing from all these various experiences. So, and if you don't mind, I'll say Quincy. Is that okay?
Oh, yes, of course. Forget the doctor.
Okay. Awesome.
We only say it once in the resume.
All right.
Bio.
So here it is, folks. So Quincy's just, again, I can't stress enough how impressive this is. So before she came to Wall Street, when Liz and I got to know Quincy, she was a U.S. diplomat serving in Washington and U.S. embassies abroad, including a posting as energy attaché at the U.S. Embassy in London. In addition to numerous assignments at the U.S. Department of State, she served as Assistant Secretary of Commerce and represented the U.S. to the IMF, International Monetary Fund, which both requires confirmation by the U.S. Senate. She studied at the London School of Economics, where she earned her master's and doctorate. She has been just ongoing for all this history we have, does appearances on television, and just this morning was on Fox Business News, which I did happen to catch. So that was totally cool. And then most recently, and as Liz and Quincy and I were discussing, we've had the honor of having Quincy speak live. This was way pre-COVID at client events. So no stranger, and we were just chatting, as some of you caught us beforehand. So I did, again, want to stress that all this experience that collectively we're bringing to the table to serve our clients, we're going to go through market ups and downs. We all know that. I mentioned before, so many years ago, so I'm going to draw my little analogy to childbirth. We kind of forget the pain, right? And, but here we are. And the big words, now we're calling them the R word or the I word, recession and inflation are certainly front of mind for many. And these are the questions that Liz and I get on a day-to-day basis. And we are looking for you, Quincy, to just enlighten us on so many different areas to dive into. So have at it. And Liz, I guess you and I can just pepper Quincy with some questions as we go along.
Sounds great.
All right.
Yeah. You want me to start?
I think
That would be wonderful. Thank you so much. If you
thank
can just
you.
dive in and.
Yeah, no, absolutely. Because obviously we get the same questions, both from clients, from family, from friends. And I question it too, right? We're all consumers. We have to remember that consumer spending in the US is about 40% of our economy. In fact, it's 70% if we really drill down on the numbers. Now, I do want to point out that when I talk about these things, I started on Wall Street on a trading floor. I worked for the team that traded the firm's own money. It was a big investment bank. And then I worked in derivatives, but I started at the bottom. But one of the things I learned, which I come back to it every time we find ourselves in these situations, which seems to be at a cycle, because we had 2008, we had 1998 that turned into a difficult period for the market. We always get out of it. And the traders I worked for, they weren't unbelievably educated. I used to tease that I wasn't sure they finished high school, but they were the best traders. They had grasp of markets. And I worked with them in global markets. And they would always say, Quince, just remember something, even the Great Depression ended, and it provides a great backdrop for great value. And they always said this too, that we trade and invest in the market we have, not the one we want. And that also helps you because we never have to be bullish or bearish. We're always pragmatic. So when we look at this particular period that we're going through, as opposed to, let's say 2008, 2009, which actually came as a shock. 2008 and 2009, it was one day after another of finding out who, like, the game Old Maid, right? Who had the cards? Who had those subprime mortgages? Where were they? And not only that, they didn't just have them a dollar for a dollar. They levered up. So it could be 30 to 1, 60 to 1. How about that? So that when they went downhill, guess what? These companies, these hedge funds, they were wiped out. That's how bad it was. And then, of course, that led to the recession. It led to the housing market just falling apart. It was terrible. It was a shock to the system. And that is different than now. It isn't. What was a shock, no doubt about it, was COVID. In March of 2 years ago was like, what? We're stuck inside. We're wearing masks. What is going on? That was a shock. So that leads us to where we are. What happened, everyone knows now, is that the Federal Reserve came to the rescue. They came to the rescue by doing things we've never seen a central bank do before. They were buying bonds outright. They buy bonds for their balance sheet, by the way. They bought mortgage-backed securities to help the housing market, thinking that the housing market was going to suffer during this period. On the contrary, we all know what happened. It didn't suffer at all, but they bought mortgage-backed securities for their balance sheet in order to make sure that the housing market was functioning normally. And they bought treasury bonds. Why would they do that? They did it in order to bring interest rates down dramatically. And boy, did they ever, because when you factored in inflation back then, in the 21, 22, you had negative rates. You factored that in, they were actually negative, not even zero negative. How great is that? Now, this is what happened also. We had the Trump administration and then the Biden administration also shoving money out, giving money to everybody. And it helped. It helped us from going into a deep, deep recession, maybe even a depression. We don't know, but it would have been dreadful. The unemployment rate would have skyrocketed. And so they cushioned, and that was the goal. They cushioned the downside in order to get us to the other side of the pandemic. That was their goal, cushioning us to the downside. But along with that, what we saw happening was prices started to rise, and they started to rise globally. Part of that has to do with recent events, the Ukraine-Russian war, Ukraine being one of the leading exporters, or they were one of the leading exporters in agricultural products, and also metals and mining. They are well known for a region that Russia just took over and always wanted, is known for, again, metals, iron ore, and so on. We know about oil. I won't have to go into that now, but I will go into it. We start turning back up. Not good for the pump, but good if you are invested in that. But we'll go over that in a minute. And so what we saw happening was all over the country, folks saying, I don't want to go to work. I've got so much money from the government. I don't really need to. And they didn't. And you saw signs all over. I almost signed up. We moved from northern Connecticut down to Virginia, and we would stop along the way and we'd see these signs, $1,000 signing bonus, $2,500 signing bonus to work at McDonald's. That's how dire it had become across the board. And then, in addition to all of this, you had the global supply chain just clogged up. Factories weren't open. Ports were not open. It was China, right? The world's second largest economy after the US, locked down, completely locked down. They were following what's called zero COVID policy, completely locked down. So I just mention this for one reason, you'll know why. Shanghai, population of 25 million, responsible for 7% of Chinese $17.5 trillion economy, locked down 2 months, 25 million people, 2 months. And then we would find out, hey, maybe they're opening it up and the global markets start opening. Why would they open? The global markets start moving up because of the idea that if China opens, they still manufacture a lot of things for us. They have a port in Shanghai, a major deep port that is responsible for the global, one of the major points for the global supply chain, that if they could go back to work, go back to the factories and get stuff out, prices would come down. And the port would be, at least initially, starting to untangle the supply chain and bringing prices down. But that didn't happen. Even today, there's a thought that they're all going back to work, zero COVID. We'll see if they can actually create a dynamic where they are back at work in China, back in the factories and so on. So we have been in this situation, and at the same time, the Federal Reserve has been saying the same exact thing until just recently. It's transitory. It's temporary. Now it depends on your definition of temporary, but we were looking at what does that mean? Temporary is not over a year, over 2 years. It wasn't. Yeah. And they finally had to change their tune. And now you see what they're doing. They're catching up. They're trying to catch up, trying to curtail inflation by bringing the demand side. That's our side of, like, you don't buy this, you don't go on that trip because it's too expensive. When you start bringing prices down because we're not spending, their goal is it's going to bring inflation down as well. The question now is, and we'll move to the next chapter here, is whether or not we'll just have a slowdown, or will they just bring us into a recession? That's the big question for the market, because if it's a recession, which we won't know about for over a year, technically, by the way, the National Bureau of Economic Research takes about a year to tell us when we went into a recession. And when that announcement comes out, invariably, we're always back up because it's over. So,
right. And I remember that with the right? COVID quick recession as it was, but I'm like, my gosh, can't they just call a recession, even though it was short?
Yeah, exactly. So there we are. And that's where we are. The market is debating whether or not it is just a slowdown, or will they take us towards a recession? But at the same time, right now, what we're seeing is the Fed's medicine, as awful as it is beginning to work. It's working. The housing market is nervous. Prices are coming down. That's what they wanted. They want prices down. You see lumber prices down. It's not a great reason for prices to come down, but it is the only thing the Fed can do. They are not responsible for the supply chain. They can't go there and say, hey, we need you to do this and do that. They can only handle demand. And I hate to say this, I've got a doctorate in economics. It's not a science. It's as much an art form, even if it's that, as it is a science. And they're doing what they think is going to work. So that's where we are. And the market is, again, trying to assess where we're headed. And you get these bounces. We hit a bear market, which is technically 20% down from the high. However, this market has been trending downward since February of 2021. It was just the recent leadership in the market that came down and really shocked everybody. That's how it works. But I know you won't think this is true when you look at your portfolio, but it's actually been orderly. So I turn it over to you, Mark.
Yeah, great. Well, let's talk a little bit about these numbers that the Fed is studying in making their decisions, because we all look at, I mean, it's kind of common terminology, CPI, but then we know that the Fed's looking more at PCE. And I think this sometimes stumbles investors. And at the end of the day, we all know it's the grocery store and the gas pump. And
Yeah.
so can you elaborate a little bit on?
Oh, of course. Yeah. This CPI, Consumer Price Index, which, by the way, if you're on Social Security or any benefits, the government pays attention to that. However, the government decided years ago, but we won't look at energy costs and we won't look at food costs because it moves too much. The only thing I'm seeing is it moves up. It doesn't move down, it keeps moving up. But no, we're not going to pay attention. So the Fed pays attention to the core. Although Chairman Powell did say in his last testimony on Capitol Hill last week, look, we do pay attention to what the average consumer is spending. We don't live on a used car parking lot. I mean, that's not where we live. And the reason I mention used cars, folks, is that, believe it or not, the price of used cars was one of the first indications that we had that prices were starting to go upward. But good news is used car prices are now down. So what we pay attention to is this. We pay attention to food and energy. Yes, we do. And why? Because the lower wage earner in this country, of what they have to spend for rent and for food and energy and gasoline, which is in transportation, they pay about 71% of their earnings in necessities, as opposed to the middle to upper income Americans whose of their wages, only about 31% goes towards, of what they earn goes towards the necessities. The other thing I'll point out, this upper wage earners actually are responsible for about 40% of all US retail sales, which is about 70% of our economy is consumer spending. So in any event, the PCE, which is Personal Consumption Expenditures Index, that's coming out this week. And yes, it is the Fed's preferred index. Typically, and notice I say typically, it tends to read inflation actually cooler than the CPI. Just to give you an example, if you take a look at the pricing for healthcare services, it tends to come in higher on the CPI than it does in PCE. Similarly, I'll give you one example too. We all know that airplane tickets have been terrible, right? The PCE typically shows it as less expensive, meaning the price is down a bit. And there are others, but typically it reads better. Now, whether or not you can sell this to the market when this number comes out this week,
Right.
Good luck, because all we know is the average American. You tell me that gasoline prices are down. I never thought I'd be celebrating $4.65. Oh, whoopee, right? And price of food. 4th of July is coming up. It's costing everyone more. So what the Fed looks at, and this is really important because we saw the Fed change course just before the last Fed meeting. Now, what happens is, folks, the Fed goes into what's called a blackout period. Thank God they stopped talking, right? They stopped talking, which we love. And then they go to the Fed meeting. What happened? They were telling us, telegraphing, because under Chairman Powell, he doesn't want to surprise markets. He wants us to know this is what we're going to do. And it's no surprise. And he was going to raise rates by 0.5%. We, in our industry, we call it 50 basis points. It's 0.5%. And we were all geared up for it. There's something in our industry, we call it the Fed funds futures market that we look at all the time. And that also had 50 basis points, 0.5%. And this is what happened. The Friday before the Fed meeting, early in the morning before the market opened, the consumer price index came out and it was moving in the wrong direction. Inflation wasn't pulling back. On the contrary, it was climbing higher. Not only was it climbing higher, it was broadening out into other areas. And this took the Fed by surprise. Now, don't get me started on why it took the Fed by surprise.
Right.
That's their job, not to be surprised, but I'm going to leave it at that. And then something happened at 10 o'clock in the morning Eastern time that also jolted the Fed's decision to just go with 50 or half a percentage. It was the University of Michigan's preliminary consumer sentiment report.
Right, that was.
What was in that report that got everybody crazy? So if you want to know what we look at, it's that report, because embedded in that report is expectations for future inflation over 5 to 10 years. Why is the Fed so worried about it, folks? It's because if it goes higher and stays higher and even continues to go higher, it means that inflationary expectations are becoming entrenched. And it's much harder to take that away and expunge it from our collective psyche. You know what else it does if it keeps going higher? It leads to hoarding. That's what happens in countries where inflation just keeps rising and the government does nothing about it. The central bank does nothing about it. That scared the daylights out of the Fed. The CPI, and then later at 10 o'clock in the morning, seeing that the consumer is now pricing in over 5 to 10 years higher inflation. It wasn't that high, but it was moving in the wrong direction, 3.3% over 5 to 10 years. Chairman Powell was asked, and by the way, you wonder, how did they telegraph to the market that now we're going to 0.75%?
Right.
Yes. So it is, they most likely had their office for communications. They know all of the reporters who covered the Fed. One of their favorites is the Wall Street Journal. They, all of a sudden, the Wall Street Journal, after in the morning saying, we're looking for 50 basis points, half a percentage, suddenly they come out with a new, like skywriting. Guess what? Fed is probably going to go to 0.75%, 75 basis points. What?
Big,
What?
Big move.
Big change. And every single headline across the internet, the newspapers changed accordingly. They were sending the message, sorry, but we have got to change. We can't. And ultimately, he told us when the Fed met, he said, look, we weren't about to wait 6 weeks, meaning for the next Fed meeting to do this. We need to do it now. We need to go after inflation before basically it goes after us and stays untenable. So that's what they did. The question now is, and this is what's interesting, what about the July meeting? What about the end of July meeting for the Fed?
Yeah.
Everyone expects another 0.75%, not 50, not 0.5%, but 0.75. Now, all of a sudden, I'm seeing in what we call the Fed funds futures market that it was 98% saying, hey, that's what we're going to get. It's starting to come back. Why would it come back? Because the market is beginning to say two things. One, we're beginning to see the supply chain even a little bit opening. Freight rates are coming down, indicative of that freight is moving more quickly. In addition to that, the housing market, yes, we've had some good numbers, but that was more, I should say, emblematic of before the Fed really hit and got mortgage rates.
Kind of a
climbing.
lagging.
Yeah, exactly.
Mhm.
And so over the next couple of weeks, and particularly March, as you said, the PCE that comes out this week will be very important in terms of the market trying to see where we're headed, whether it's 50 or 75. Many of the Fed speakers are coming out and saying, well, we could go with 75 basis points. It's clear what the Fed wants to do is, while the labor market is still healthy, go after inflation. Go and try to just choke it off. Yes. So that's where we are.
I'd love to jump in back to our conversation about the VIX and about how all this does impact the market. And again, I remember back 0809 sitting at a small table and you were talking about the VIX hitting 40 and why that was so important and warning us that it was going to go higher. And today we're sitting around 27. And earlier you mentioned, it's different this time. I would love to get your thoughts on that.
Yeah, no, absolutely. Because we get asked this all the time, because the notion is that when the market bottoms, it is, every last person sells. That's what we look for. The last hand just gives up. sells. It's, I can't take it anymore. I'm going out. And usually it's climatic, and usually it's correlated with some event, something that hits the headlines. Because remember something else, 40 to 50 to 60% of daily market volume isn't me, it's not our traders, it is algorithms. Yes, high frequency trading, and they grab onto news, and boy, do they move to the up and down. So what is the VIX? It's the volatility index. Where does it come from? It comes from the Chicago Board of Options Exchange. And it just means that if I believe that things are going to get worse and the S&P 500 is going to collapse, I may buy downward protection on the S&P 500. So that when it goes up to 45, what that means is lots of people were terrified and they pushed the price up. That's what it means. So it really hasn't gone up. It did when COVID hit, right? And that was a shock. The difference this time is, and compared with 2008, 2009, when it seemed to go up every other day because this bank was going under, that was the old maid card was found somewhere else, is this is orderly. That's number one. And we know why. It's not a surprise. We know that it is the Fed raising rates to curtail inflation, right? The question though is, and this could be a shocker and push that up, is if we turn around and everybody's firing people, that all of a sudden everything goes completely negative. That would be a shock, a complete shock. And that could also push the VIX up and people saying, holy moly, this is it, it's terrible. But overall, this is a market that is waiting for signs. Just as Mark said, what are we looking at? You saw last Friday, for example, last Friday, the University of Michigan final report came out about consumer sentiment. And guess what it had in there? It actually showed that the average consumer in America saw inflation over 5 to 10 years actually pulling back from the one that got the Fed to change tune during the blackout period. Right. When that hit, the market gained tremendous move up. It had already been up, it had been oversold, but it really pushed it up, because what we're waiting for, just like the Fed is waiting for, are signs that inflation is in fact pulling back, plateauing. You've heard the term peak inflation. At LPL, we use the term plateauing because that's a process. It's a process of prices coming down. So that's why I think that the VIX has been calm, because people kind of understand this isn't some big shock. And as I said, could we have a shock? Yeah, yes, I could come up with, I don't want to depress everybody, 4th of July weekend coming up. I could come up with shocks, but so far the market's okay. We get it. We get it. It has been orderly. And, bear markets have a certain process that they follow before we bottom. And by the way, maybe it's because I came from a trading floor, that was my background. We have a saying, the market gets the news first. The market gets the news first. And we watch to see, what is the market telling us, right? Because it tends to turn when you least expect it. And I'm keeping my eye on industrial metals. Is it about China coming back? Is it about that the market says, wait a minute, things are really going downhill, but they don't go downhill forever. And you wait for that turn.
Well, and that's a good point. And that's where, Liz and I in our advisor role and working with our clients, and we can say it. It's almost like parenting. We can say it and we can say it, we can say it. Sometimes it falls on deaf ears. Cycles are going to happen. We position portfolios for all, not knowing if there's going to be, and I'll use the term black swan event, like a 100-year pandemic, or back in the early 2000s, dot-com boom and bust. We've got a position for all kinds of weather, which is what we do. And I just find sometimes, again, back to those deaf ears, let's think about how far the market has moved since the depths of 2009. And we were just kind of running through this. I mean, as measured by the S&P, I think we're up about 500%.
Exactly, Marge. Exactly. And may I throw something in just because we're talking about Chairman Powell? Because I think this is important to show how the market works. It's like a GPS system sometimes. Back in 2021 at a Federal Reserve press conference, I should point out the tech names were going through the roof.
Right.
The stuff I don't even understand, the memes and all of that was going through the roof. And I'm like, oh my goodness. So the market was expensive. So those of you who follow the market, we talk about price to earnings ratios. It was about 22 times forward earnings, right? That it tends to be expensive. And it actually ultimately went to 23 times forward earnings, which is expensive. So at the press conference in 2021, one of the reporters said to Chairman Powell, sir, aren't you concerned about how expensive the market is and how much risk is being taken in the market? Doesn't it worry you? Chairman Powell, whom I want to point out, is not a PhD economist, which is, I think, a good thing. He's a lawyer. We won't hurl that against him. He's actually worked in capital markets. This was his answer. He said, no, I'm not worried. He said, when you have interest rates so low, in fact, negative rates, because if we factor in inflation, he said, the cost of capital is negligible. He said, you can have a more expensive market. That's what he said. And he said, in addition, we intend to keep rates low for a very long time. Well, fast forward, I guess it depends on your definition of very long time, but fast forward, rates are climbing higher. So therefore, we have to respect what's going on. Rates are climbing higher, and then the market needs to find a new equilibrium of the price for the S&P 500. And March, that's what it's doing. And in what is it, almost 2 weeks, we're going to start the unofficial opening of the earnings season. Now, remember, we look back, we look at second quarter earnings, but it will be the guidance of those earnings calls, because actually American companies are doing well. It's a little bit lower, but not much. They're making money.
Right. There's still growth. I mean, our economy is still growing.
Yes, exactly. And even among the Federal Reserve speakers, Williams, who is head of the New York Fed, which is probably one of the most influential of the Federal Reserve system, besides the Fed in DC, the main Fed, came out and said, I think it's premature to be talking about a recession.
Mhm.
Yes, the economy is still growing, albeit much more slowly, but companies are making money. Nike came out and said, hey, we're doing okay. We saw a deal. I never thought I would see a deal with this much money, $61 billion, Broadcom buying VMware in the middle of the market coming down. Now, granted, it's kind of dormant now, but I suspect at some point you're going to see more deal flow because the valuations are becoming increasingly attractive.
Right.
When you see money going out of the market, much of it is forced selling. It's not that, oh, I don't like this company, I don't like that company. Get me out. You get a margin call, get me out. Hedge funds, get me out. And what's happened is some of the top companies that we have, they're not going anywhere, but their share prices are down. And now is the period that we believe you're going to have a broad swath of very good companies that will just present themselves. And it's going to turn the corner, and we're going to go into a recovery from this bear markets. That's how we are looking at it. We're not Pollyanna. All of us have tremendous experience in markets. We're pragmatic. We're never bullish. We're never bear. We're just pragmatic.
Well, and on the recession front, I mean, let's just talk it out here. So if it comes to fruition, and whenever, 23 maybe, 24, who knows?
Yes.
And by definition, I guess it's 2 quarters of negative growth. But the NBR has their own definition.
Exactly.
And trying to read the tea leaves, which don't exist. And And if it does occur, okay, maybe it's shallow. Maybe it's not to the
Exactly.
extent
Mhm.
back that we recall the 08, 09. Like we kind of forget about 2020. It was so short, so fast.
Exactly.
So
You're
I'll go
right.
back to 08, 09.
Mhm.
And what our clients are saying is, but here's the but. Yes, I remember 08, 09, but I was working, but I wasn't retired. And back to Liz and my position, okay, but we've already gone through the planning to determine what your needs are going to be. We have diversification in portfolios for this very reason. So I'm kind of throwing a couple different things out there. So what has been a challenge has been to see the fixed income market get hit so hard. So I know you're equity strategist, but I've got to throw that kind of comment question out there.
No, absolutely, because because you have a portfolio where if the equity market goes down, you're saved by the fixed income market. The good news is that it looks as if it is calming down. We went through a difficult period. Remember, at the same time, the market has been told that the Fed's balance sheet is going to be wound down. Remember, they all the purchases they had, $9 trillion that ballooned the Fed's balance sheet. That was quantitative easing. The other side of it is called quantitative tightening. And they are this month starting that process of mortgage-backed securities out, treasuries out. Now, one other thing in this whole situation is, you mentioned 2008, 2009, that when we came out of 2009, how do I say this? A number of the restrictions put on the banks had them move away from being dealers in treasuries, and therefore created, you remember the repo situation? And the Fed had to step in. That's one of the concerns. The other concern is that the Fed is by design tightening what we call financial conditions. They're doing it deliberately. And the way they deliver that tightening of design is through the stock market. It's through mortgages. It's through everything. And the worry is, are they going to tighten it too much? Are they going to break something? That's what we call it, breaking something. And how do I say this? We don't know. They don't know. Obviously, they're not trying to do that. They're just trying to, he said, to give us a softest landing. But we just don't know, and they don't know if they can do it. And he even used the R word. He said, well, you know, it may lead to a recession. Now, one of the things that he said, and I want to point this out in terms of the treasury market, if that's the one that gets broken, they're right in there. They're not going to let that. They're not going to let liquidity. The Fed is going to have to come right in. They know it, but it's not as though they work all by themselves. They work very closely with Wall Street, with the banks that are in the treasury market, so they know what's going on, so they can be there. You know, they've learned from the repo problem in 2009. But what we know is the treasury market was off the skids. I mean, it was like more munis. I mean, how, you know, we love our munis, but it is calming down. I do want to mention one thing, though. We look at the high yield market very, very closely. During this period when money was so cheap for the last couple of years, the high yield companies, which formerly called junk, most of them went out and borrowed. They borrowed from the market because it was so easy to do it. And it was so inexpensive. So they're flush with money. In fact, American companies have $1.9 trillion on their balance sheets, not counting the financial companies. They went out and raised money when they could. But the high yield market, we're watching, when we say the spreads, folks, you know, it shows you nervousness in the market. Those spreads have been widening, which indicates fear that something can blow up, that a junk bond can just fall apart. However, when we talk to our folks in our committee who come from the treasury market, who come from the fixed income market, they say it's more a fear of what they're used to. than an actual fear.
Interesting.
Because yeah. And by the way, when we talked about the VIX not going berserk,
Mhm.
you'll get somebody who'll say to you, well, Quincy, I followed the credit default swap market. Credit default swaps, it's called the CDS market, is the insurance that I buy if a company defaults on its bonds. I could do it for the United States of America. I could do it for Russia. And so that has gotten more expensive. So if you saw that, you would say, well, why isn't the VIX getting worried? Why isn't the equity market getting worried? There's an instinctive reaction in the market when you go into a bear market that something is going to happen and that the Fed is going to break something as they tighten financial conditions. And it's something we have to live with. You've prepared your clients. We've prepared our portfolios at LPL accordingly. But we look at it, we monitor it constantly to make sure that we are positioned correctly if something happens, either an exogenous outside shock or that the Fed has gone too far too fast.
Right. And as you said, they have tools in the toolbox. And
Yes, yeah.
if they push that brake too hard, then they're just going to have to pull out the oil or something.
Marcia, there are those who believe, and believe it correctly, these are astute observers of the market, that the Fed could do one thing very quickly: stop doing quantitative tightening. All right, raise rates, but don't do any more quantitative tightening. Just stay put. That's one way. The other way are the tools that they could do that they've used over and over again that have worked. So again, that is the concern, and we should have more information of where we're headed once we go through the earnings season. And I can't stress enough the guidance. What are they telling us? What, companies are making money. I know there were issues with Walmart, issues with Target. We thought the world was going to come to an end. And then Nordstrom comes in and says, I don't know, we're doing fine. I go to Home Depot. They were doing fine. It's stock specific.
Right. Very good point.
And
Let's
I
move
love
some other questions from.
Well, actually, I'm going to go a little bit off the list to touch on, you just talked about how corporate America has a lot of cash. Are you seeing a lot of cash in consumer pockets still? So again, we talked a lot about the stimulus and how that basically was out there and people did not have to work. Is there still cash on the consumer sideline as well, or has that been spent through?
That's a brilliant question. That really is, because that's extremely important. Yes, we're seeing cash still. I could argue that there is approximately $2 trillion in the system, right? Wow. However, if you listened, and I suggest folks try to get on, and you just have to type in, listen to Darden, right? Olive Garden, Darden. Mm-hmm. Listen to what they have said. There are restaurants that are poised towards higher prices, have done very well. The lower end that they own, not so well. There is a major division in the country between those who are the high net worth or even medium and the lower. The Fed, and this is interesting because this is a change, and I would say over my time, I never heard the Fed talk about lower income people versus higher income people. The Fed is very concerned about lower income folks, very concerned for a host of reasons. Right. They want to make sure that they have jobs, and they want to make sure that they are okay. But I would have to say this, that as the stock market comes down, those who are in the higher net worth usually are the ones most associated with the stock market. Right. It will probably curtail their spending as well, even if it's at the margin, because they're concerned. Many of them want to retire too. Obviously, they retire with much more money than the others. But yes, there is cash. One of the things we're seeing, though, is folks using their credit cards more, and not for points, but to pay for things. And also we're seeing a dip in savings. When we look at the combined data that we receive from the banks, there's a dip in savings. So it's dissipating, but it hasn't disappeared.
And then taking that one step further, so we are seeing, whether it's the Fed or just the government in general, worrying about those lower income families. And that's where a lot of the stimulus has come from. There's talk on the table, I believe still, of potential more stimulus. I think they call it the gas relief. So is this stimulus and checks being sent out, and I'll call it printing money, is that kind of exacerbating the problem and kind of kicking the can down the road even further?
Yeah, yes, it is. But yes, it is. But I would have to say that globally, at least in Western Europe and in the US, there is little tolerance to have the market do its job to clean things out. You will hear people say, why can't the market just do its job and clean things out? Get rid of the companies that shouldn't be around. We call them zombie companies. They do well when money is cheap, but basically they should be gone. It is that there is a reluctance to allow unemployment to skyrocket. Paul Volcker inherited a mess from Jimmy Carter. Inflation was 15%. President Reagan came in and said, hey, just do what it takes to get rid of this inflation. And he did, but unemployment went double digit. But by the time, and this is a good way to segue to when the market changes, right? You never know. August of 1982, the unemployment rate was over 10%. It was close to 11%. By the way, that was the period that Paul Volcker was actually coming to lower rates. There was an problem in Mexico, but he felt that he had done his job with inflation, but still very high unemployment. And one of the most enduring secular, meaning long-term bull markets in American history began when you least expect it. And that's why we say, you know, if you go out into cash it, oh yeah, you're brilliant. And I'm going to get personal here. My husband one day said to me during a previous period, get me out of the market. I can't sleep at night. And I said, you're going to go back in? I don't know. Don't ask me if I'm going to do it. I said, you sure you want to do this? He said, yes. He hasn't gone back into the market. No. Okay.
Yeah, and we see that. We see.
I know.
Well, and we so appreciate that candor, because Margie's saying you have to get it right twice. You have to.
Yes, but you can't. You
Right,
can't.
right.
And this, Margie, hear me out on this. Chairman Powell has turned around twice now since he's been Fed chair. Just the other day, when he went from 50 to 75 basis points, he suddenly changed. But here's another one. Here's another one that we know he can change course on a dime. And if you're out of the market, guess what? You're out of the market. You go try to beat the algorithms, the high frequency trading that just swoop in and push the market up in a nanosecond. It was, do you remember 2018? It was Christmas Eve.
Oh,
I remember.
Yes, we
yes,
remember.
I remember. I was fixing Christmas Eve dinner. We were having a lot of family in, and I'm in this little tiny kitchen, and I'm poaching fish, and the steam is like getting to me, and the market is tanking.
Oh, yeah.
And I just remembered, because when I worked on a trading floor, the guys would always say, remember, Quince, when the market's closed, you can't lose money. And on Christmas Eve, the market closes early.
At one.
And
Yeah.
I'm looking at the clock. And here's the point I want to make. Why was the market doing that? Because the month of December in 2018, the market lost the majority of the 19% that we lost in that year, because the Fed had raised rates in December and then said, oh, we'll probably raise rates in 2019. And the market is like, are you crazy?
Right.
We're just about going into a recession. Are you nuts? Anyway, he turned the corner. In the pre-market, it was the futures market that got the message. It was in January of 2019. No one expected it. He was at the meeting of the American Economic Association. It was the day that the labor market the report came out, a Friday morning. And he says the Fed is going to be patient, which in turn, it means no raising rates. In fact, they lowered rates in 2019. The market swooped up in the futures market and never looked back. Good luck if you thought you were a genius to leave
Exactly.
on Christmas Eve. Good luck to you.
Yeah.
And that's
Liz
what
and I
think.
remember it well. We're like, well, I guess we're gonna be spending Christmas doing some tax loss harvesting.
Yes,
Yeah.
exactly, Marge. And so that's why what we have now, what we live with, whether we like it or not, remember, we invest in the market we have, not the one we want. We don't have governments, Republican or Democratic, that say, hey, let the market just clean things out. Let's get the market to function the way the market should function, how things are really worth. Doesn't happen anymore. The central banks swoop in and cushion the downside. Again, whether I like it or don't like it, that's what we have to work with.
So I'm gonna switch gears because I even though
Okay.
we would love to just keep talking for hours,
Yeah.
just so awesome. And thank you.
Oh, thank you for inviting me.
So a couple things, if you can make a couple comments on energy.
Oh.
Certainly huge shift, and Liz and I, we say all the time to clients, we'll listen to a point on their political positions. However, at the end of the day, our job is to be good stewards of their money with them. So it's important that we acknowledge where we are politically. However, it is not a game changer in our decision making.
No, and it's difficult because, if you say anything, okay, so let's go over it. We have supply constraints, not just here in the US, because we are not pre-COVID exploration and drilling. No, we have not. President Biden came into office and his first action as president was to say, I'm not signing the Keystone Pipeline. Not that that pipeline would have given us oil now or whatever, but he gave us the backdrop of what his administration thought about fossil fuel. Okay, that's what I'll say. And so corporations, the big integrated names, the gas and oil names, I'm just saying this, everyone knows this is Chevron, this is Exxon, this is Occidental Petroleum. They're like, okay, they're doing whatever they do, but this is what they're doing. They are giving back to the investor. They're sweetening their dividends. They're doing share buybacks, but they're saying, don't force us to go out there and drill and do this and that and then cut the price. We're taking care of our shareholders. You've seen some drilling out in the Permian Basin, but nothing compared with what we saw before. America had become completely energy independent. And we were exporting. That we were completely energy independent. And in my mind, that is probably one of the most important things that we would have, which however energy we use, it was fossil fuel, granted, but we were independent. And then we find ourselves on this side of the problem, and we need more oil. And even just say, for the sake of argument, say we're like Europe. Europe is, the EU has said 2035, they will all be electric. There's still a period in which you need diesel, because a lot of the cars there are diesel, or you need fossil. You can't just turn it off overnight. And so we find ourselves now with a problem. COVID seems to be finished. Americans are traveling, and oil prices are quite high, much higher than, how do we say, when President Biden came in. Interestingly, when we do the surveys of how consumers talk about inflation, by the way, future inflation, 5 to 10 years, it is highly correlated with the price of gasoline, believe it or not. So we like the energy sector. We were oversold. And folks, when we talk about oversold, we saw a lot of selling in energy. We saw a lot of selling in the other commodities, copper, iron ore, all down on the back of concerns that we are headed into a recession. Because the thinking in the market is, oh, when you're in a recession, you're never going to drive. You don't even have a job anymore. You're sitting home. So demand is down. In addition, China has been closed down, and they are appearing to open. I do want to point out that they get the majority of their oil from Russia, as does India. So we need to know that. But OPEC, the de facto leader of OPEC is Saudi Arabia. Now, this is interesting, and I don't want to get into a discussion, and I'm not going to because I'm not talking to any of you. We're not live. I mean, we're seeing you. So I could say this, you could flip off if you want to. But this is the interesting part. The Biden administration came in, and relations, how should we say, with Saudi Arabia completely deteriorated for a variety of reasons, humanitarian reasons and so on. Saudi Arabia and the rest of OPEC are, as best they can, trying to come back to levels of oil production to pre-COVID levels. And they had it mapped out. Each month they would bring in a bit more oil to barrels of oil per day. What they did in the last OPEC meeting is this. They took the 2 months in the summer to the fall, and they brought that up. But in other words, it's not new. It's just that they took it and said, okay, we'll bring that forward. So that, think of it that way. They are saying, along with the UAE, another major oil producer within OPEC, saying, but we have supply constraints. Don't ask us to do much more. We have supply constraints. So there you are. Now, President Biden is, I believe, still headed to Saudi Arabia to work out that relationship, mend fences, talk about the Middle East, and perhaps try to have them find some oil somewhere. Aramco has lots of oil. And we'll see if he comes back with more oil, an agreement for more oil. He knows very, very well that that price of oil, the gasoline, even if he were a Republican, he would be blamed for it. Not Putin, no one else, but whoever is in the White House will be blamed for pushing up the price of oil. We know it from elections, we know it from focus groups and so on. So he will try everything. The irony of this is this idea of a holiday would bring 18 cents on the federal tax out of the price for gasoline. And there's another, the tax holiday would also include diesel. But if we added the states in there, the calculations suggest that a 3-month tax holiday, both on the state level and the federal level, would lead to a savings of $30 a month with a once a week fill up. Is he going to get it? Chances are no, because Congress has to approve it. And even many Democrats are saying, no, we're not going to do this. The interesting part of this is, let's remember what the Fed wants. The Fed wants the prices to come down also, but the only way they can get it down is if we stop using it, we change our driving habits. And the way that they have gotten prices down a bit is to have everybody scared out of their minds that we're going into a recession. The entire industrial metal complex, including commodities on food, including commodities on oil, down, down, down. They have just turned the corner. You will notice they come back up yesterday and today. They were oversold because everyone was, hey, get me out, get me out. Now we're going into a deep recession. With China possibly coming back on board and their economy, world's second largest economy, and their government trying to do what they can do to get the economy growing again, all of a sudden you're seeing industrial metals turn the corner, oil turn the corner. Now, whether or not this is viable recovery, we don't know yet, obviously, but supply constraints are there. Typically what we say in this industry is that the weak hands, oh, I went into commodities because I know that, prices are going up and they only go up and I'm going to go invest here. The minute things turned, the weak hands leave. Yet it still leaves a commodity complex, including oil, that is has tight supplies. So this is where we are with it. Expectations are that we will see prices climb before they come back down. Granted, more recession talk will certainly bring the price down, but that will be the price in order to bring it down. Do we need oil? My view is yes, we do. Even if we all go electric in 2045, you need the transition. I'm not running for office, but sometimes I sort of think, what are people thinking? So I'll leave it at that.
That's,
Thank you.
that's great. And Liz, you want to have any parting?
Oh my
comments?
goodness. Well, number one, thank you all so much for spending an hour, and thank you so much, Dr. Krosby. This is
Thank you.
amazing. I
Thank
think
you.
if we have time for one last question, what keeps you up at night, and what what do you think about for your family and for our country, and where we go from here?
Oh, that's where I run for office. So I'll remember that you asked me that. I always say, don't short this country, don't short the market, don't short the United States of America. I mean, are things selling? When I heard that Germany, for example, was doubling their budget for military expenditures, I was like, I can't believe this is happening. Granted, it's from a low level, but all of the countries at the border with Russia are increasing their spending on defense. The US is behind in the hypersonic missile systems. Even North Korea has something. So we in this country, the best defense is a strong defense. And I'm beginning to see signs that this administration is moving in that direction. So that makes me happy. But there's something about the American spirit that, in spite of Washington, D.C., despite Washington, D.C., companies are born. In the midst of all this, business formation is increasing. Apple, for example, was created during a recession. And I'll leave you with this. This to me is emblematic of our country and why I feel positive. And on a personal level, I just got a refrigerator. After being in our house, which we've owned for a long time, but which has fallen apart, I couldn't get a refrigerator. And our general contractor makes Eeyore look cheerful. And he said, guess what? I've got some news. We got the refrigerator. And I'm like, oh, hallelujah. But this is what I want to leave everyone with. Apple celebrated a major anniversary just some months ago, right? And we still talk about Apple. We talk about the founding of Apple, don't we? We talk about where they're headed now. The CEO who has led it since Steve Jobs' death. Let me ask everyone a question who's listening to this. Do you all remember Alibaba? When Alibaba was the thing, the Chinese company that everybody was talking about, and the creator of Alibaba was all over Wall Street, all over the news, CNBC, Bloomberg, Fox. We looked at him like he was the new Steve Jobs. Has anybody seen him lately? Has anybody seen his name come up? The answer is no. The Chinese authorities making sure of that. That's the difference between our country and theirs. And we have to respect it with all of the issues that we have. An election is coming up in the midterm election. And I should say statistically, the market does very, very well historically. I say historically, as we have that election. And it also coincides with the two best months of the market, November and December. But the market tends statistically to move up. It shows that our country works. And regardless of who wins, regardless of who takes over, it shows that, again, we go to and we vote and we have a winner. It looks as if right now, if we were to have the election right now, that the Republicans would take over both houses. The market likes that, right? The market likes that, maybe tax cuts down the road, but the market also does well under Democrats, believe it or not. Some people say to me, Quincy, that's not true. Well, it happens to be true. Just look at the data. The point is, because American companies do whatever it takes, regardless of who is in the White House and in Senate or in the House of Representatives. So I leave you with that. Don't short this country.
I love that. And what a great way to kick off what will be the celebration of the independence of our country.
Yeah. Yes.
Amen.
Yeah.
Amen.
Thank you so much for your time and your knowledge and your experience.
Thank
It's
you.
always such a blessing and so insightful. So thank you so
Thank
much.
you. And thank you for your friendship, all of you. It just, it's wonderful.
It really is.
Take good care. Bye.
You too. Bye-bye.
Bye-bye.
Bye. Thank you all for attending today. Have a wonderful rest of your day. and happy 4th of July. Stay safe. God bless America.